Hey guys, thanks so much for tuning into the channel today, guys. I have a great show for you guys today and a special guest I'm bringing on to the channel today. We are starting a new segment called The Mortgage Maze, and we're going to be talking today with Stephen Knorr with Alcova Mortgage of the Knorr Group right here in Harrisburg. Stephen, guys, is a plethora of knowledge. I've known Stephen for years. We do a lot of business with the Knorr Group, and with, guys, so much happening in the real estate market and with the mortgage market, guys, things are changing all of the time, and I thought it would be a good idea for us to keep up to speed on some mortgage topics as we try to navigate the choppy waters that we're going to face ahead. So what I want to do is bring Stephen on here in just a minute and talk about a topic that everyone's talking about right now, which is called the 2-1 Buydown. So guys, stay close to the channel because we're going to be bringing these segments to you guys every single week, talking about a different mortgage topic. So let's get Stephen in here right now and see what he's got to say about this 2-1 Buydown. So Stephen, are you there? There you are. How are you doing today,
Yes,
sir?
sir. Good morning. Good morning. It's an honor to be on the channel. Thank you, Brian.
You bet. You bet. Stephen, give us a little bit of an intro of kind of what you do, what you've been doing, and a little bit about your team.
Absolutely. This is my 17th year doing mortgage loans. We specialize in residential lending with a focus on relationships. So we're not transactional like websites. We want to build a relationship, get to know you, get to help you, your family, and build a sphere in this local community. We do lend in North and South Carolina as well as Virginia, mainly the Southeast, but kind of focus here in Cabarrus and Mecklenburg County.
Awesome. Awesome. And yeah, Stephen, you and I have been doing business for about 4 years now. A lot of people that maybe even are watching this channel right now have talked to you and your team to get help and get financed. Some of them have even probably closed, and a lot of them are probably in queue getting through the pre-approval process. But one of the biggest buzzwords that's happening around the mortgage business right now, with affordability being an issue, interest rates, of course, have been elevated. Thankfully, they've come down a lot. When they were in the mid 7s, I think we're probably trending, just a little bit over 6% today. But affordability is still an issue, and a lot of people still need to buy a house right now, right? So this 2-1 Buydown has been buzzing around. It's helping people get into a house with a lower payment, but I don't think a lot of people really understand it. So that is the topic I wanted to chat with you about today. See if you can give our viewers a little bit of context around what this is, how it can help people, and what are the pros, what are the cons, if there even is a con. I see all the advantages in it. So tell us about this 2-1 Buydown.
Yeah, I would love to, Brian. And I'll share a little bit of a worksheet, but first a backstory. A lot of the calls we're getting right now have to do with affordability, but it's also people not being able to afford their rent. Rent is just escalating at an astronomical pace. And, the people the average consumer can't keep up with it because inflation is real, and inflation has driven the rates up above 7s and still has them in the mid 6s. So the temporary buy down is a way to combat interest rates now, but also fix your payment in and probably save those renters a lot of money on a monthly basis. So the concept is it's a strategy. So strategies don't work for everybody, but we like to get out strategies because it might hit home for you watching, whereas it might not work for your neighbor. But basically the 2 and the 1 are percentage points. So in my worksheet I'll share here in a second, the average rate's around 6.5, let's just say, and it might be a little bit lower depending on credit score and down payment and things like that. But the 2-1 Buydown strategy would take your interest rate the first year and lower it by 2 percentage points. So you'd be paying a payment based on an effective rate of 4.5. The second year, you'd be paying an effective rate of 5.5, which is the 1 year, 1% reduction. And then years 3 to 30, if we get to that point, you'd be paying the same rate, 6.5, that you would if you didn't use the strategy. So for us on our side, we're kind of like, it's a program that can lower your monthly payment right now, and it's also part of the contract negotiation. So that's why it's so important to work with an amazing real estate agent like yourself and your team, Brian, because we negotiate this into the deal. So it is a seller credit, and it's a seller the seller subsidizes your payment. And the money that is put in an escrow account, it can be refunded when and if we refinance. So the whole strategy behind this is we're assuming that interest rates are going to go down. The federal government let inflation get out of control because they didn't raise prime rate enough. Now they're going to overdo it to make sure that the rates come back down. So this strategy hasn't been around for a while because we've been in a decreasing rate environment. So all of a sudden, when rates shot up literally almost 2 points overnight, people were like, what am I supposed to do? Well, here comes this cool new strategy we have. But a lot of folks are like, well, I've never heard of this. Well, because when rates were just going down and down and down, we didn't need to talk about temporary rate buy downs. They were already at the basement. So this whole strategy is used with the assumption that hopefully later this year, maybe it rolls into Q1 of 2024, there's going to be a refinance wave where fixed rates get back into the fours, and you've got some money in the kitty to kind of help offset a refinance cost. So if you want, Brian, I can share my screen and kind of go over some numbers so that everyone can kind of see what this looks like.
Yeah, let's definitely do that. Before we do that, though, this 2-1 buy down, it can be used on any mortgage product, right? FHA, conventional, or VA?
Yeah, but you did say a keyword, purchase. So it's for a purchase of a primary home. So investors, I love you guys, but this isn't a strategy for you. It's a fixed rate, so it's on all 30-year fixed rate products. And one thing that comes up is it is not an ARM. It is not an adjustable rate mortgage. Those rates start here and then adjust up and up and up. This temporary buy down, you have a fixed rate and you actually get to reprieve on that the first 2 years. So that's one of the misconceptions that is out there, but it can be used with USDA, VA, FHA, and conventional loans for a primary purchase.
Awesome. Yeah, I would love to take a look at what this looks like. And guys, as you're watching this, if you have questions about what Stephen's talking about, drop them in the comments. And next time we get together for our next video, we'll circle back and answer those questions before we get into our next topic on the next video. But Stephen, go ahead and share your screen and let's take a look at this.
All right, you should be seeing my screen, Brian. Can you confirm?
I can confirm. I have you right here. I believe we are good to go. All right, Stephen, I got your screen. Tell us about the 2-1 buy down.
Awesome. As you can see, there's a lot of numbers on this screen. I'll go through these. I can also share this workbook with Brian so that he can put a link below because I used a $400,000 purchase price, which in our area is a pretty good purchase price, but maybe you're looking below that, maybe you're looking above. These numbers will change as long as you work in the green. You can kind of run some numbers yourself, but this is a $400,000 purchase price. I used an average interest rate of 6.5, which is about the national average, give or take, again, credit score and points. This is just for us to put some numbers. I need to make the term 30. And the down payment is going to be 20%, which is standard. Again, you don't have to put down 20%. We can do loans for as little as 3% down in conforming, and certain loan programs are no money down. But for this model, let's assume that it's a 20% down. So that would have an $80,000 down payment, and then your loan amount of $320,000. All right, if you didn't use this strategy, your rate would be 6.5. And that would be the monthly payment up here, years 3 through 30. That would be $2,022 for P&I. I'm estimating the escrow. That's going to change per property because it has taxes, it has insurance, and then it does not include HOA or PMI. But for the sake of this exercise, we're going to focus on the P&I, principal and interest column right here. So like I said, the 2-1 buy down would take your 6.5, and your first rate would be effective of 4.5. And your second year would be 5.5. If you come over here to these columns, you can see that would drop your payment from $2,022 down to $1,621 the first year, and then $1,816 the second year, which would save you $401 the first year every month, and $205 every month for the second year. And if for some reason you got to year 3 through 30, you'd just be right back at 6.5, which is the same rate you'd be locking in right now. So what's the catch? Well, it's not free. So you have to negotiate this. So if you wanted the full 2-1 buy down right here in yellow, the seller would have to come up with a credit for $7,200. That's negotiated into the contract because this money is taken, it's set aside into an escrow account, and then every month the mortgage company we pay the difference in those interest rates. So it's a subsidiary program. The positive to that is that that money is yours. It's in an escrow account with your name on it. If you did a permanent buy down, which you may have heard people say, let's buy points, that's buying the rate down for 30 years or 20 years, whatever the term of the loan is. In this model, if we go back to what we were just talking about, the whole assumption is we're going to do a refinance, hopefully within 6, 12, or 18 months. So if you spend thousands of dollars to buy a rate down over 30 years, you're never going to get the return on that. That's why this strategy gives you the power to get a reduced payment, lower than you could buy it down over a 30-year time period, but have some refund potential, which if you see right here in this model, if I were calling you in 6 months and saying, hey, it's time to refinance, rates are in the 4s, you would have $4,800 of kitty, your money, still available in that escrow account to either, number one, offset most of the cost of your refinance, if not all, or you can use it towards principal reduction on your payoff. If it goes a full 12 months, you've still got $2,400. If it goes a year and a half, you've still got $1,200 sitting there. So that's where this strategy makes sense to me, because if I'm going to take 6.5, I might as well try to get it down, and you don't have to do the 2-1. You could also just do a 1-year buy down. So if you did a 1-year buy down, you would go 1% down and be paying the 5.5, which is still a $205 a month savings. In this market right now, and Brian, this is your expertise, but we're seeing sellers kind of willing to deal, right? There's price reductions, there's seller concessions on the table. So this money is yours to negotiate a contract and a payment where you can truly see some value, because to me, and I think most people will agree, $400 a month savings is a lot of money, and especially $200 even. That's bills, that's utilities, that's inflation is hitting us all in the pocket. So that really helps the affordability for those looking to move up to the next house, but especially those people who can't really afford their own rent. They can be a homeowner now and be saving money every month, and that's a huge win for everyone.
Yeah, and I think this is awesome. So, as we're negotiating our deals for our clients, we are trying to incorporate this strategy. And like you said, right now in the market, sellers are willing to negotiate because their house that would have sold in 2 days is now sitting on the market for 30 or 40 days. These sellers are not only willing to come down in price, but they're also willing to give up $10,000 or $12,000 in concession. So in this example, for example, if we were to get a $12,000 closing cost concession for a client, they can use $7,283 to fund the buy down, and that still leaves you just under $5,000 remaining to put towards closing costs. So really, in a lot of cases, we're getting our clients into these houses for just their down payment or just a little bit more than that, because the closing costs are paid for by the seller to fund the buy down and the majority of the other closing costs. So yeah, this is a super awesome strategy. Like I said, it's been the buzzword around here for a couple of months, but I want to make sure everyone really understood that. So good stuff, Stephen. I appreciate you sharing this.
Absolutely. And if anybody has any questions, I'll give Brian the link to my calendar. This is what we do. I exist because I care, and I'm here to serve and help. There's so much information on the internet. That's not always a good thing, but the local guys like myself, we live, to serve everybody out there. So don't try to figure it out yourself. We're the professionals that are here to help you, and would love to have a conversation.
That is awesome, Stephen. Let me bring you back on the screen here. We can wrap this one up here. Hey, Stephen, thanks again for coming on today, guys. I hope you enjoyed the topic of the 2-1 buy down. If you haven't subscribed to the channel, go ahead and do so now so you don't miss any of these other segments of the Mortgage Maze. And I'm so excited to bring these to you guys. And if you liked the video today and thought it was valuable, give it a like. And guys, we are gonna wrap this one up, and stay tuned for next week. We've got additional topics coming to you on our new segment called the Mortgage Maze. Stephen, once again, appreciate you hanging out with me today. And guys, have a great day, and we'll see you next time.